FUBO TV, ticker symbol FUBO on this one. The stock has performed tremendous the past year. It's up 168% the past year. You gotta be flipping my flapjacks. That's pretty epic. But the last 3 months, it's done nothing. Nothing. The last 3 months. People are looking at this one like, what's going on here, right? Well, everybody's waiting. We're all waiting for the Disney Hulu live TV deal to go through, right? And FUBO put out this just a couple days ago. They said, thank you for all that attended FUBO's annual shareholder meeting today. We understand there's a lot of interest related to the Disney Hulu Plus live TV transaction. We take this opportunity to remind everyone that we cannot comment on the status of this transaction, why the deal's basically going through, right? So they can't comment on it right now, right? For legal reasons. But as soon as that deal does go through, the hype's going to be insane. The hype's going to be insane in regards to FUBO, what this means for FUBO, and then they're going to have so many exciting things to talk about. It's going to be crazy. No, of course, there's always a potential. I think it's a lower probability, but there always is a lower probability that the deal does not go through. Keep in mind, from what I remember in regards to this situation on the legal front, is if the deal for some reason does not go through, from what I remember, I believe FUBO gets $100 million or so, roughly, somewhere around there, from what I remember. So if that's accurate, like, that's a lot of money. My hope is the deal goes through. I think Disney wants a deal to go through. I think FUBO wants a deal to go through. I think everybody wants a deal to go through, right? So hopefully that deal goes through. I don't see any reason why it shouldn't go through. FUBO's not a big enough player. If it was YouTube TV making this deal happen with Disney, Hulu, I think that would be an issue because YouTube TV has such a dominant market share already. FUBO's a little guy on the block. So the fact that they and Hulu combine, if anything, you look at that and you say, okay, they're going to compete now in a stronger position against YouTube TV, which will create more competitive environment in this, for consumers. So if anything, I would, from the government perspective, I'd say this is actually a good deal for the consumer, right? Now, additionally, when they reported their last quarter, they made such tremendous progress with this company, right? Operating loss fell to only $25 million from $63 million in the same quarter last year. Revenue went to $416 million from $402 million. Everything's headed in the right direction for FUBO for the last couple of years now at this point in time, right? Cash and cash equivalents exploded upward to $321 million for this company now at this point in time, which is great because they keep cutting down their losses. They're hardly taking any losses now at this point in time, right? Which is phenomenal because you got a company taking these little small losses now and could flip to profitability next year, right? And we have a situation here where they're loaded with cash. Oh, baby, right? Now, keep in mind in regards to FUBO, it's about to be the big time. You know why? Because we're about to go into July here in just a bit. July and August are the summer months that we're leading up to football season, right? NFL training camp start in July. You actually get some college football games starting at the end of August, like the last week of August, essentially, right? And you get preseason NFL football to start in August. So you're going to start seeing signups for FUBO start to accelerate quite significantly, even in August. But the big time comes in September, because that's when the college football season fully kicks off and the NFL season fully kicks off, right? Which I'm sure there's a lot of guys watching this right now. They're like, thank goodness, can we wait? I can't wait till finally we got something to do on the weekend, right? Watch some dang football. But September, October, November, December, huge months for FUBO. FUBO's known very well for attracting the sports fans. Before I was even a FUBO shareholder, I was a FUBO customer. And the reason being is I love to watch college football. The issue with college football is you got 1 trillion different games on 1 trillion different networks, right? So you need somebody that's got everything all in one place, and FUBO does a great job of that. And also FUBO has the ability to have 4 games on at once on your big screen, control whatever games you want up there, which is phenomenal as well. And so it's about to be fun times in regards to FUBO, right? And imagine we get this deal approved in the next month or two, and then we go into the big sign-up season. Like, oh my gosh, that's going to be banger, right? Now, some people want their stock lower, right? I saw this here today. It said, FUBO, bring it lower. I wanted to add in the 280s, this individual says, right? My guess is it holds 3s, and we go up from there. That's my guess in regards to this one, right? I saw somebody post this on X, says they just passed 70,000 shares of FUBO. They're on their way to 100,000 shares before the merger. He says it's literally going to print money, which they might not be wrong on in regards to that, just to be honest, but still, man. Some people take some risk out there. Like, I don't know how much money that individual has, but that's a lot, man. That's a lot of shares. Like I think about myself, the public account, I got 20,000 shares of FUBO. I own shares in other portfolios as well. But if you add up all my shares, I'm not at 100,000. It's something lower than that. And obviously, my net worth is rather on the aggressive side. And so I'm just like, that's a lot of shares, man. But people like to take risk. That's all I'll say about that, right? And I'm sure a guy like this is thinking I'm going to have 100,000 shares. Stock's going to go to $30, right? And maybe they're right. It's just for me, I'm very bullish on FUBO, but man, there's levels to bullishness. And I'm not on that level. Holy smokers, that ain't no dang jokers, right? Hey, I want to thank you so much for watching that clip. I hope you really enjoyed it. What I'm showing you in front of your face right now is 1000xstocks.com. This is such an important website and service to use if you want to research companies, if you want to understand companies on a high level, so you can hopefully get better results in the market. And we know as the years tick on, money compounds. It is so important you research companies, you compare companies, you're listening to conference calls, looking at SEC filings. All that's included into 1000xstocks.com. So to enjoy 1000xstocks.com and to apply for that service, you can go to the description area of this video, or you can go to 1000xstocks.com, whichever you prefer. HNST stock, HNST. This stock, since its lows that it reached in 2023, this was a time when it became obvious that their business was turning around, the financials business was turning around. Since that time, the stock has climbed 326%. That's versus even NVIDIA, which has climbed 206% over that time. It's even smashing NVIDIA, right? That's crazy. The Qs are up since that time, 42%, S&P 500 up 37%. So it's almost 10x the S&P 500. Incredible. Now, in regards to Honest, the thing you guys got to understand here, right? I understand the stock was up 7% here today, but just understand this stock is still trading way too cheap. Way too cheap. People are eventually going to wake up and realize Honest should not be traded. Keep in mind, if you look at Honest's growth rates, it's been far exceeding companies like Procter & Gamble and Kimberly-Clark, which are companies they should be compared against, right? But look at Honest's price to sales ratio on a trailing 12-month basis. 1.2 versus 4.4 for Procter & Gamble and 2.1 for Kimberly-Clark. And once again, you can make a strong argument that Honest should be in a much, let's call it higher price to sales ratio than these other two companies, because Honest has a far better balance sheet. You look at a lot of these other companies, a lot of them have huge debt loads, right? Honest is loaded with cash. They're debt. Oh, what is that? We don't even know what that is. What? Debt? Huh? And Honest has way better growth rates. So if anything, Honest should be trading at price to sales ratio above Procter & Gamble and above Kimberly-Clark, not below and not significantly below. That's crazy talk. So Honest, I like that stock, man. I like that stock. Hey, I want to thank you so much for watching that clip. I hope you really enjoyed it. What I'm showing you in front of your face right now is 1000xstocks.com. This is such an important website and service to use if you want to research companies, if you want to understand companies on a high level, so you can hopefully get better results in the market. And we know as the years tick on, money compounds. It is so important you research companies, you compare companies, you're listening to conference calls, looking at SEC filings. All that's included into 1000xstocks.com. So to enjoy 1000xstocks.com and to apply for that service, you can go to the description area of this video, or you can go to 1000xstocks.com, whichever you prefer. Now, in terms of Nike, what are my feelings about this? Am I feeling good going into the earnings? Am I feeling a little scared? Things like that, okay? Well, first off, let me say this. I'm 0% scared going into these earnings. Why? Well, Nike is such a clear buy to me right now. So if Nike goes down, it goes down to 55 or whatever, cool. If the stock goes up to 70, cool. I don't care. Nike's a huge buy at 70. It's a huge buy at 65. It's a huge buy at 60. It's a huge buy at 55. It's a huge buy at 50. It means nothing. So whatever happens to Nike short term is kind of irrelevant. I'm not rooting for Nike to go up right now. I'm also not rooting for it to go down. I'm just, whatever happens, happens in regards to that whole situation, right? Now, as far as the earnings go, the good news is the expectations are on the floor if you're hoping for the stock to go up and people to get excited. 12 cents EPS expected for this quarter, not much. 32 cents expected for the next quarter, not much. 53 cents for that following quarter, not much. And so the expectations for Nike here are on the floor when it comes to this company, okay, for EPS, which makes it much easier for them to potentially come in with beats. As far as revenue goes, analysts are expecting this quarter they're about to report to be down 15%. Next quarter to be down about 8%, and the following quarter to be down about 4.5%. the expectations are really, really low for Nike. And now the numbers don't matter as much as the guidance and kind of the conviction in regards to where the business is headed. So, do keep that in mind. I personally feel pretty optimistic. But with that being said, it just doesn't mean much to me. Certain stocks I really root for to go up on earnings, like Meta. Meta's one since it's such a massive position for me. I always root for Meta to go up, right? Nike's at a point in time where it's kind of no man's land for me, so I'm indifferent. I'm indifferent. If it goes up, great. If it goes down, great. If it stays flat, great. It's kind of a win all the way around for me, at least for right now, right? Now, starting next year, that's going to be a whole different story for me in regards to Nike. I'm only going to want Nike to go up next year and after, essentially. But for now, because I still am an active buyer of Nike. So for me, I'm kind of, in that sort of place, right? Now, what about this whole U.S.-Iran situation, right? Here's what it means to the market. Not a lot. The oil market, it's going to shake up the oil market this week. At the end of the day, the oil market, in my personal opinion, I have no concrete evidence of this, but in my personal opinion, if it looks like a duck, quacks like a duck, it's a duck, right? In my personal opinion, the oil market is commodities market in general, is heavily, how do I put this best? I manipulate it. That's my personal opinion. And so what this means for the oil market over the next few months, wherever they want to manipulate the price to, they'll manipulate the price to. But as far as what does it mean for this week, I would assume oil prices will be up. What does this mean for outside of that? Not a lot, right? You could say, well, maybe that'll raise inflation expectations a little bit, potentially. But the Fed should look right through that. Because that just is what it is. What's the Fed going to do? Keep rates higher, so that's going to hurt oil demand? Come on, man. So, but then again, the Fed's been acting foolish here recently. Not the first time they've acted foolish. So we'll see what happens with that. But, yeah. At the end of the day, I do not think the U.S. wants to get involved in a full-scale war with Iran. So I don't think it means a lot. That's what I'll say about that, as far as right now, at least, right? Alrighty, let's get into Tom Leah's opinions and perspectives on the stocks in the market, and then I'll share my opinions and perspectives.
Chris Harvey, Tom's a CNBC contributor. You also make the argument that all this concern over inflation related to tariffs is also...
That's the Professor Jeremy Siegel. I see him.
Make the argument that all this concern over inflation related to tariffs is too aggressive and overdone.
That's right. So what you hear is, here's what should be happening. Prices should be going higher. You hear that from economists. You hear that from the Fed. You hear that there's a lag. What we look at is what's actually happening. And what companies are saying is, we see tariffs. We're going to mitigate them to the best of our ability, and they are. Right? If you look at Costco, what is Costco saying? We're not going to raise prices on a lot of that day-to-day stuff. We'll raise it on discretionary. We'll keep the basket under control, and we're really not going to push along inflation. And that's what's happening. So this whole belief that we're going to see this inflation shock, I don't think it's really well-founded. If you're looking at the data, if you look at what companies are doing right here, right now, and what you expect them to do, inflation's not going to be a problem.
I think, Tom, you agree with that, don't you?
I do. One of the things that I think helps is if you go to the May CPI report, core inflation was 0.13% month over month. The goods component was in deflation, which is affected by tariffs. And then if you look at core, the two biggest contributors were housing and auto insurance. That was 0.14. So outside of housing and auto insurance, we had deflation in the May CPI report. I don't think tariffs are going to cause housing prices to go up, nor is it going to cause auto insurance. So to me, the Fed is, I think, shifting to looking at expected tariffs, but not realizing the real driver of inflation. 75% of inflation since 2019 was housing and auto insurance. Those are both actually starting to cool.
So are we all, not we, you, three, all suggesting that the Fed, I think the professor already said as much, that the Fed should cut rates in July? Harvey, you first. It sounds like yes.
So what the Fed has said, which I agree with, the Fed's saying, hey, the economy's still strong. We still have time to take a wait-and-see approach. It's in our best interest to do that. And I don't think they're going to move in July. I don't think they should move in July, but I do think
You
later
don't
this
think
year.
they should move in July?
No, I think they can take their time. I think they can take another meeting or so, let the data come in, convince themselves of what they need to convince them of, and then we'll normalize later in the year. And then we can all just move forward.
So, Tom, do you agree with that? I mean, you agree?
Listen, when's the last time the Fed took this approach of, we'll wait it out, let's see what happens, when's the last time they took that approach? I can tell you when. It was in 2021, right? Inflation spiking all over the place, and they kind of just like, oh, it's not that bad, we have time, we can wait it out, right? And they wait, 2022, it gets even worse and worse and worse, and numbers just go higher, and the next thing you know, they're freaking out, and they're like, oh my gosh. So here we are in another situation where the data shows you they could easily start cutting rates now, right? Or in July, we could say, right? Data fully supports that. Fully supports that. You can start cutting. Or you can take the approach of like, well, just keep waiting, wait until what? Then to actually have a recession later this year or next year, let's say, for instance, right? Or the economic data get a lot worse. And then all of a sudden you're in a economic bad situation and you got to cut rates all the way to zero right away. Come on, man. Like, what are we waiting for? The Fed can't, play the whole we're going to wait around game again. They're going to end up, in a bad situation again. And last thing, the Fed should be in a situation where they have to cut rates to zero again, right? But if they wait too long and then you get a recession, they're going to cut rates to zero again. And the Fed, that's unhealthy and no different than what happened with the Fed in 2022 into 2023, raising rates at the fastest clip we've ever seen. That's crazy. Like, they shouldn't have been doing that. But they waited too long and they paid a heavy price for that, right?
Waller might be jumping the gun here with...
Oh, we shouldn't say they paid a heavy price for that. We paid a heavy price for that. The people paid a heavy price for that, right? In terms of inflation.
For July?
I think if we looked at the Fed's framework that they've repeated in statements over the last 8 meetings about data dependence, then they should have cut, or they should be cutting in July. So I think this last meeting seemed to have changed the guideposts from data dependence to forward-looking expectations around tariff inflation that I think is why markets are starting to question the Fed's rationale. And Professor Siegel points it out, long-term inflation expectations are lower today for 1 year forward than they were in December. So we've gone through a full tariff liberation day and expected inflation's lower. Yields are actually lower. I think the market is moving ahead of the Fed and saying the Fed should be cutting sooner.
So at what point is the market going to get, Tom, too upset by the pace that appears to be slower than it would like?
Well, there could be an accident, right? Because I think what we are ignoring is housing is choking and collapsing under the weight of higher interest rates. And the labor market isn't as strong as it appears. I mean, when we look at the ability to get a job, it's much harder. So as Professor Siegel says, there's long and variable lags. There could be an accident where the Fed will have to panic. So I think that's something we have to watch in the incoming data.
When you say accident, what do you mean? On the long end of the curve, like rates go up too much? What do you mean?
Good question.
No, I think that there could be a point where the Fed suddenly realizes the risks are actually to the downside for the economy weakening. And so the Fed will actually have to respond to an economy that they're strangulating and really fighting what they believe is a supply shock inflation. So I'm a little concerned that the Fed could be late if they continue to hold.
Yeah, and here's the issue, a big issue in regards to this matter, right? The Fed right now could gradually lower rates. They have the time to gradually lower rates. They don't have to go straight down like, oh, we're cutting 200 basis points tomorrow. They have the time to gradually lower, right? Which is very predictable. The market can kind of understand where the Fed's headed. They're like, oh, they're probably going to cut another 25, 50 basis points next time. They can make those moves. Or what they could do, wait too long, then you have economic actual problems, and then they start going into panic mode, and they start having to cut 75 basis points, 100 basis points at a time. Or like they did in the Great Financial Crisis. I think there was one time, I think they cut like 200 basis points or something like that. Ridiculous. So, like, if the Fed was good at their job, they'd be able to gradually adjust rates and not have to panic and just, do what they did in 22, 23, just raising at insane numbers. I mean, there's no reason the Fed should ever be lowering or raising interest rates by 75 basis points at a time. You know, anything even over 50 is just crazy. If they're doing that, that's a clear signal they screwed up bad. So if all of a sudden they wait, then you start actually getting some bad economic data at some point later on this year, next year, and then they start having to move 75 basis points, they'll be them admitting again they screwed it up again. Like, it's just ridiculous, man.
Adds to the uncertainty, the Fed's roadmap and the Middle East, you throw that into the mix too. We're not really sure what's going to happen there. What's your best idea now in light of all that?
Best idea is still AI. AI has run, but it's still, if you're looking 12, 24, 36 months out, it's still that AI trade. This is not like the late 90s. The player's not like the late 90s. The opportunity's not like the late 90s. This has legs. The AI diffusion, the Mitigation of AI Diffusion Act has given it legs, and we will continue to see AI. That is the U.S. secular robust trade. That is the trade that you need to be in if you're not in already.
Tom, you guys sound like you're sharing research.
Yeah. I mean, I broadly agree. I might add that I think interest-sensitive groups are going to benefit because they're going to start to look forward and realize the Fed, if they are a little slower this year, they're going to be more dovish next year. That's good for financials. You know, it is good for the industrials, really good for Bitcoin and small caps as well.
Professor, when you look at the tech trade, do you...
So let's be clear about what's good for small cap stocks and what's not. A situation where the Fed gradually lowers rates 25 to 50 basis points at a time over, let's say, 6 to 12 months, span, that would be very good for small caps. Because that would mean the economy is not in some sort of disaster situation. It means the Fed's making predictable moves. I'll tell you what's not good for small caps is in any sort of situation where the Fed has to make a drastic decision, like cutting also in 75 basis points, 100 basis points, something like that. So that means the economy is in a bad place, which is also not good for small caps. So if we can get 25, 50 basis point lowers time and time again for a bit, very, very bullish for small caps.
Feel like the stocks are overvalued, or do you believe Harvey, which says, no, they're giving you every reason and they keep telling you and proving to you, including in the most recent earnings season, exactly why money should still go to those stocks?
Well, AI is very important, and certainly those companies, I think, will continue to prosper, but let's not forget about the AI users. And I think it's in the infancy of use to cut costs by, regular firms that are not, in technology. And I think in some ways, tariffs might be one of the things that pushes them to more intensively use AI to cut costs. We saw during the pandemic, all of a sudden, people use Zoom. They saw, well, I don't have to have a business meeting, in Chicago or someplace.
Before we go further here, they asked about, is the market overvalued? So I say, let's go ahead and take a peek and let's answer that question. Is the stock market overvalued right now? So in order to understand if the market's overvalued or undervalued at a particular time, you need to think about a very important subject, and that is, what are the stocks that matter the most to the stock market? And for that, we know it's like the Mag 7 type stocks, right? So we need to look at the valuation. So we'll pull up the compare tool here on 1000X, right? So let's go ahead and start going through them. Let's talk about Apple, right? Let's talk about Mr. Softy, Microsoft, big dog. And let's talk about NVIDIA. And let's compare these companies, okay? So Apple, 27 forward P. Is that rich? It is if Apple has trouble growing the business moving forward. Now, with that being said, is 27 forward P rich for one of the most amazing business models we've ever seen? And if they can grow at these sorts of growth rates, like, analysts have next year Apple growing at 7% revenue, 14% earnings per share. Gosh, if they do that, is Apple really overvalued at 27? I can't say it's overvalued. I wouldn't also say it's undervalued, but could I say it's fair? That's fair. That's absolutely fair, right? Mr. Softy Microsoft, I feel like I'm going to sneeze. 33, a 33, forward P on this one. For a 33, I mean, if you're growing double-digit top line, bottom line, 33 is not rich. Not for a SaaS company, right? Which is, Microsoft just recurs that revenue again and again and again. They obviously have Azure, which is another business that just recurs that revenue again and again and again. very similar to like an AWS. So at the end of the day, Microsoft at a 33, I can't say it's undervalued, but I can't say that's overvalued. Not with the growth rates and not being as sticky of a business model as they have. NVIDIA, 37. You can say, ooh, now we're getting pretty rich, right? 37, that's about double the forward P that an average stock in the market trades at. Listen, look at next year's expected earnings per share growth for NVIDIA. Let's have the earnings per share growth for NVIDIA next year being 44%. Next year, they have the revenue going up another 33%. Listen, man, if the company was to actually grow at those rates, which I do have some questions, next year revenue growth, I don't know. I have them more in the 15 to 20% range. But let's say hypothetically they do 33% and a 44% net income, EPS number, then a 37 is not rich. It's not rich for NVIDIA, if that's a situation. So right off the bat, we can't say Apple, Microsoft, or NVIDIA are overvalued. The argument for those is either they're undervalued or they're fairly valued, right? So then you take it to Google McDougal, right? We're going to go a little lower here. We're going to go Meta, and we'll go Amazing's on. The next three big dog companies that matter the most to the stock market. Google's at a 17 forward P. Analysts have revenue going up 12% for them next year, earnings per share up 9%, a 17 forward P. And think about how diversified Google's business model is between the cloud business, between Android, between Google Search, between YouTube, right? Their AI applications, Waymo, holy smokes. That ain't no jokers. I mean, at the end of the day, Google's an extremely strong argument to me that made that stock is very undervalued right now, right? Meta, forward P 26 on this particular stock, with next year expected earnings per share growth of, let's say, 14%. Analysts have them next year revenue growth of 15%. I think their earnings per share is going to be better than what analysts have. That's my personal opinion as a Meta shareholder. That's undervalued. Meta's undervalued. Google's undervalued here. Amazon, 33. Okay, here we go again. It's like, is this richly valued, right? Well, Amazon has growth for days, right? EPS growth expected 20% plus next year. Revenue growth, double digits next year, right? And a business model that we can understand how they could continue to grow for years and years to go in the future between AWS, the advertising side of their business, and the e-commerce side. So Amazon's another one that you can either make an argument it's undervalued or fairly valued here, but you can't make an argument that it's overvalued. These are stocks that matter the most to the market. And so when you look at the top of the market like that, it's like, it's very hard. Then you can say, okay, what about big oil and gas companies, right? Like ExxonMobil, right? Like Chevron. Like these stocks don't matter as much as they once did. And you can say, what about big financials like JP Morgan, right? Big doll, $700 billion plus market cap JP Morgan. Well, forward P on Exxon's 18, right? And we'll see what happens with the price of oil, but there's a potential that the price of oil goes up, at least in the short term, right? So I think it's hard to make an argument that ExxonMobil's overvalued here. Once again, that's just kind of one I would just look at as fair value. I also don't think it's cheap here. Chevron, I mean, if they hit these sorts of revenue growth numbers, earnings per share growth numbers that analysts have here, I think they're looking pretty good. JP Morgan, next year expected earnings per share growth 6%, revenue growth of 4%, pretty sleepy. 14 forward P for the most well-rounded financial out there. I mean, it's hard to make an argument that the stock market is overvalued when you look at the top of the market and you look at those best companies. You either come away kind of feeling like that's fair value or that's undervalued. You don't come away saying, oh, it's a ripoff. Like if I buy JP Morgan stock, what a ripoff that is. Oh, Google stock at a 17 forward P with double-digit top-line, bottom-line growth. What a ripoff. Come on, man. Meta, 26 forward P, double-digit top-line, bottom-line. What a ripoff. No.
Around the world, we could use other technologies that did cut costs at that time, and so the users could benefit in the future as much as the producers in the AI technology space. So, I'm very optimistic about firms implementing AI to cut costs, maintain margins, or even maybe expand them despite the tariffs.
Are we going to be okay, Chris, this next earnings season? We were better than expected in the last one.
Right.
And I don't know what's going to be in the next one, but what about this one that's coming up after the second quarter earnings?
I think so. Everything we're seeing from the consumer is still okay. You're seeing some weakness, but not a ton. CapEx still really strong. The shock from April really hasn't affected things all that much. I think if you have that weakness, but we get some progress on trade and tariff, people will look through it. But if you're asking the question, are numbers going to be solid? Numbers will be solid.
Yeah, Tom, you agree with that?
I do. I mean, I think companies have proven many times over the last 5 years that they are incredibly resilient and adaptive. You know, this is really the fifth shock that they've absorbed. I do think one of the consequences of sort of surviving COVID and fastest hikes in history and now this tariff shock is that investors are going to start to assign higher multiples to the companies that are succeeding. So I do think PE expansion is a theme we should think about the next 12 months.
All right, we'll leave it there, everybody. Good weekend to all. Professor, thank you as usual. And Tom and Chris, we'll see you again soon.